Welcome to the Deep Dive, your express route to becoming truly well-informed without drowning in a sea of information. If you've ever found yourself staring at your retirement plan, maybe wondering if you're doing it right or just feeling, overwhelmed by all the financial jargon, you're definitely not alone. Planning for retirement, it's become this incredibly intricate dance, hasn't it? And everyone wants to secure their future, but finding clarity in that maze of solutions, well, that's the real challenge. Today, we're taking a really close look at a major player in this space, Jackson Financial Inc., or JXN, as you'll see it ticker-wise. They're a pretty significant independent force in the U.S. retirement solutions market. And their stated mission, which I find interesting, is to clarify the complexity of retirement planning for Americans.
Which is quite a mission statement, considering the complexity of their own business.
Yeah, exactly. We think that mission resonates not just for their customers, but also for us, right? As we try to understand the mechanics of a company like JXN itself. So our goal for this deep dive is really to cut through that complexity for you. We've sifted through, a stack of sources, financial reports, investor presentations, industry analyses, basically trying to extract the most important insights. We want to give you a clear picture of their core business, their rather intriguing financial journey since becoming independent, and the strategic shifts they're making right now. Think of this as your personal shortcut to being deeply informed about a company that's really at the heart of America's retirement planning ecosystem. Now, as we explore JXN, we're going to see this fascinating duality at play. You'll quickly grasp why their official GAAP earnings can swing so wildly. It's almost like a financial roller coaster sometimes.
It really can be.
While at the same time, their core operating metrics remain surprisingly stable. We're also going to shine a light on a truly pivotal development for them, this brand new captive reinsurance entity called Brook Re.
That's a big one, a really big structural change.
Absolutely. And how it's designed to transform their financial stability. And we'll examine JXN's, frankly, aggressive commitment to returning capital to shareholders.
Very aggressive, yes.
All while balancing the risks of their sort of legacy business with the exciting opportunities in their new growth areas. There's a lot to unpack here, so let's dive in. Okay, so let's begin by understanding where Jackson Financial actually came from. Many of you might remember them operating under a different, much larger corporate umbrella.
Yeah, they were part of Prudential for a long time.
Exactly. But JXN truly forged its own path, emerging as a standalone entity back in September 2021 after that demerger from Prudential. Today, they operate as a U.S. domiciled financial services holding company, and its primary engine, its main operating subsidiary, is the well-known Jackson National Life Insurance Company, or JNLIC. And their core mission, as we touched on, is quite compelling: to assist Americans in both growing and safeguarding their retirement savings. In an era where financial markets can feel like, an enigma, JSN aims to bring clarity to that complex landscape.
And that's not just marketing speak, right? It's hitting on a critical function in today's financial ecosystem.
For sure, especially as more responsibility for retirement falls squarely on individuals.
It's true. The clarity of that purpose is noteworthy, particularly when you consider the inherent complexity of the product they actually offer. To connect this to the bigger picture, Jackson is directly addressing a profound and, frankly, expanding societal need. We're witnessing this widespread shift away from traditional defined benefit pensions.
Right. The old gold watch and a pension type deal is feeding fast.
That's exactly. Which means individuals are increasingly responsible for their own financial longevity. Jackson steps into that void, offering tools, for self-directed retirement security.
Precisely. And to truly understand how they fulfill that mission, we need to break down their revenue streams. How do they actually make money? JXN primarily generates income from three key components. The largest, by quite a margin, is fee income. This is derived from fees they charge on the assets under management, or AUM, within their variable annuity contracts. So here's the straightforward insight. If the equity and fixed income markets perform well, and the value of those assets grows,
which they generally have over the long term,
right, then JXN's fee income rises in tandem. It's pretty directly correlated to market appreciation. And next up is spread income. This comes from the net investment income they earn on the general account assets. These are the assets backing their fixed and fixed index annuities.
Think of it like the bank's net interest margin, but for an insurer.
Yeah, that's a good analogy. Imagine it as the profit margin they make. It's the difference between the yield they achieve on their investment portfolio, which typically consists of, high-quality bonds and commercial mortgages, and the interest rates they promise, or credit, to their policyholders. This income stream, as you might guess, is particularly sensitive to fluctuations in overall interest rates.
Definitely. If rates rise, they can potentially earn more on new investments. If rates fall, it can squeeze those spreads.
Finally, a smaller but still contributing part of their revenue comes from margins on other insurance products, rounding out their overall financial performance. So what you have is a diversified approach, sure, but one that is definitely exposed to the currents of market performance and interest rate changes.
That's a critical point. The immediate takeaway here is that while these revenue streams are robust, their stability is inherently tied to broader market conditions. That fee income, while substantial from variable annuities, means exposure to equity market downturns.
Right. A bear market hurts them directly.
And spread income, as you highlighted, fluctuates with interest rates. This direct market exposure is why their sophisticated risk management and hedging strategies are absolutely central to their entire operation.
They have to be.
Without it, their financial picture would be far, far less predictable.
And the products themselves that generate these revenues are quite sophisticated. Historically, their cornerstone has been variable annuities, or VAs. These are long-term, tax-deferred investment products where clients can allocate their money into various sub-accounts, mutual fund-like things that invest in stocks, bonds, or money market instruments, allowing for market-based growth potential.
But the kicker is often the guarantee.
Exactly. A huge selling point for many of JXN's VAs, and a key reason for their historical popularity, are the optional riders that offer guaranteed lifetime income benefits, like a personal pension. This is where it gets interesting, though, because while this massive block of in-force VA contracts is a primary source of that stable fee income.
It's a huge pool of assets generating fees.
It is. But it's also the main driver of their market risk exposure and necessitates extremely complex and, frankly, expensive hedging programs. Now, shifting gears dramatically, a key strategic growth area for Jackson since late 2021 has been registered index-linked annuities, or RILAs.
Yeah, these have really taken off across the industry, not just for Jackson.
They really have. These are hybrid products sort of designed to offer a middle ground between the full market exposure of VAs and the principal protection of fixed annuities. They link returns to market indices like the S&P 500, offering a degree of market participation. But the real innovation with RLAs is their downside protection mechanism.
That's the main appeal, right? Some upside, but with a safety net.
Totally. They either come with buffers, which absorb an initial percentage of market losses, say the first 10%, or floors, which limit your total loss to a predetermined percentage. And the growth here has been remarkable. RILA sales surged from $1.8 billion in 2022 to $2.9 billion in 2023. That shows really strong consumer appetite for this kind of product. Then, for those more conservative investors, JXN also offers fixed and fixed index annuities, or FIAs. These products are primarily focused on principal protection. Traditional fixed annuities credit interest at a declared guaranteed rate. Very predictable, very safe.
Old school, reliable.
Yep. Fixed index annuities, on the other hand, link the interest credited to the performance of a market index, similar to RILAs, but typically with caps on the maximum return you can get, or participation rates limiting you to a percentage of the index gain.
So you get some index exposure, but it's buffered. Less upside potential than a RILA generally, but often more principal protection.
Exactly. These are designed for conservative growth without direct market risk to the principal investment.
So the immediate insight here, and it's a really useful framing device, is that Jackson is effectively operating with a tale of two books.
A tale of two books. I like that. Explain.
Well, you have this immense, historically profitable legacy variable annuity block. It's the primary source of their fee income. It's huge, but it comes with a substantial market sensitivity and those big hedging costs we talked about. Then on the other side, you have the growing, more dynamic RILA and FIA business. That represents their future growth engine and, importantly, their diversification strategy.
Away from the VA risk concentration.
Precisely. This duality is absolutely fundamental to understanding Jackson's overall corporate identity and strategy right now.
It's a brilliant way to frame it. And connecting these products to their reach, Jackson boasts a really impressive distribution network. This is a significant competitive advantage.
Oh, definitely. Distribution is king in this business.
They have around 500 broker-dealer partnerships, which gives them access to over 120,000 financial advisors across virtually all major channels, wirehouses, independent broker-dealers, banks.
That's massive reach. It's an invaluable, intangible asset that isn't, sitting as a line item on their balance sheet, but it's incredibly valuable.
And beyond that traditional reach, they're also strategically and aggressively expanding into the registered investment advisor, or RIA channel. That's a big growth area in wealth management.
Fee-based advisors.
Yeah.
A different model.
Right. By the end of 2022, they had agreements with nearly 1,100 RIA firms, connecting them to over 10,000 investment advisor representatives. And they recently hit a significant milestone in 2024, achieving $1 billion in advisory sales.
That shows real traction in a channel that historically hasn't been a huge annuity market.
It does. It shows a clear intent to capture growth in that rapidly expanding segment. And critically, Jackson places a huge emphasis on award-winning customer service and robust brand recognition. In a financial industry where trust is, frankly, everything, these elements are invaluable. They differentiate the company and help foster those long-term relationships with advisors and clients alike.
You can't underestimate the power of brand and service in retaining advisors and customers. So the overarching insight from this segment, pulling it all together, is how Jackson's entire corporate strategy is really engineered around managing this tale of two books.
It all comes back to that.
It does. That massive, profitable, but inherently risky legacy VA block generates substantial cash flow, right? But it also necessitates that complex and costly hedging program, which, under GAAP accounting rules, leads to significant earnings volatility. So every element of Jackson's strategy, their sophisticated risk management, the establishment of Brook Re, which we'll definitely delve into shortly, and their capital allocation decisions, it's all designed to carefully manage the risks of the VA block while simultaneously funding and nurturing the growth of their newer RLA and FIA products.
It's a continuous, sophisticated balancing act.
Absolutely. A high-wire act in some ways.
Building on that foundation of Jackson's business, let's widen our lens now and look at the broader U.S. annuity market itself. Because it's currently experiencing an incredibly robust period of expansion, like really strong.
Yeah, the numbers are pretty staggering, actually.
The industry has actually achieved record-breaking sales for 3 consecutive years. That's 2022, 2023, and 2024, collectively surpassing a mind-boggling $1.1 trillion in sales.
$1.1 trillion, that's huge volume.
And this momentum, it's showing no signs of slowing down as we move into 2025. First quarter sales alone have already exceeded $105 billion. That marks the 6th straight quarter where sales have topped the $100 billion threshold.
Wow. 6 straight quarters over $100 billion.
Yeah. So the immediate takeaway here is that this isn't just some fleeting trend. The annuity market is experiencing a sustained period of really high demand.
The striking element here is to understand the powerful engines driving this remarkable growth. Why is this happening now? It's more than just a momentary surge.
You're right. And arguably the most powerful of these engines is the demographic tailwind, often referred to as the silver tsunami.
The aging population.
Exactly. Think about this. Over 4 million Americans are projected to turn 65 each year between now and 2029. That is an enormous cohort of individuals transitioning into retirement, looking for ways to secure their financial future. And crucially, this demographic shift isn't happening in a vacuum. It coincides with that well-documented decline of traditional employer-sponsored pensions.
Fewer safety nets from employers.
Right, which means there's a growing retirement savings gap. People are living longer, thankfully, but they also have fewer guaranteed income streams from traditional sources. This creates an acute and frankly urgent need for financial products that can provide guaranteed lifetime income, which is a core, invaluable feature of many annuities.
Individuals are increasingly responsible for funding their own, potentially very long retirements.
Another key driver has been the recent market environment. The volatility we've all witnessed in recent years, combined with a period of higher interest rates.
Which we had for a couple of years there.
Indeed. That combination significantly increased consumer demand for products that offer both principal protection and predictable returns. This environment has been a major catalyst, particularly for sales of fixed-rate and fixed-indexed annuities.
People got nervous about the market swings and liked the certainty.
Exactly. And even with projections of interest rate declines possibly coming in 2025, the underlying demand for protection and reliable income is expected to remain high. People remember that turbulence, they want security. Finally, product innovation has played a transformational role, especially with the explosive rise of those registered index-linked annuities, or RLAs, that we talked about earlier.
The growth there is just incredible.
It's astounding. Back in 2015, RLAs were a pretty niche product with only about $3.7 billion in sales for the whole industry. By 2024, that figure had skyrocketed. to $65.4 billion.
Wow, from under $4 billion to over $65 billion in less than a decade.
Yeah, that's a clear indicator of a product meeting a significant market need. This expansion highlights widespread adoption, too. The number of carriers offering RLAs grew from just 4 to 21 over that same period.
So lots of companies jumped on the bandwagon.
They did. These products have successfully captured demand from a segment of investors who seek that middle ground. Some participation in equity market upside, but without taking on the full downside risk. It's proving to be a really compelling hybrid solution for many.
Okay, so while the growth narrative is undeniably strong, it's vital to ask, what structural challenges does this industry still face? The annuity market, despite its current tailwinds, isn't immune to headwinds.
The good point. It's not all smooth sailing.
Not at all. For instance, interest rate sensitivity is a bit of a double-edged sword. While higher rates undeniably boosted sales, especially for fixed products,
Made those guaranteed rates look attractive.
right. But a projected decline in rates in 2025 could potentially temper demand, particularly for fixed annuities, and it could also impact the profitability of spread-based businesses for carriers like Jackson. This is a constant balancing act for them. Then there's persistent competition and fee compression. Annuity providers operate in a crowded financial landscape. They face stiff competition from lower-cost alternatives like ETFs and traditional index funds.
Always pressure from the low-cost options.
Always. This competitive pressure puts downward pressure on fees, which means carriers like Jackson must clearly and effectively articulate the unique value proposition of annuities, things like tax deferral benefits, and, crucially, those lifetime income guarantees features, which are not always intuitive for consumers or easy to compare directly with an ETF. And we can't overlook the ever-present and ever-evolving regulatory environment.
Oh yeah, that's a big one for insurers.
Huge. The industry is subject to this complex web of state-level regulations primarily, but also with federal oversight. Changes in capital requirements, new product feature rules, evolving sales practice standards like those best interest rules, or even shifts in tax laws. All of these can materially influence product design, compensation structures, and sales processes.
So they have to constantly adapt.
Continuous adaptation and significant compliance investment are just part of the cost of doing business.
Absolutely. It's a fiercely dynamic arena. So how does Jackson stand amidst all this? Where do they fit in the pecking order? In terms of its competitive position and market share, based on 2024 year-end sales data, Jackson ranked as the 8th largest seller of individual annuities overall in the U.S. That's pretty high up. They had impressive total sales of $16.8 billion.
Solidly in the top 10.
But where Jackson truly dominates, reflecting its deep legacy, is in variable annuities.
Still the VA powerhouse.
Totally. In 2024, JXN was the #2 seller of VAs in the entire industry, with $15.3 billion in sales. They trailed only Equitable. This vividly underscores the immense scale of their legacy VA business and their enduring relevance in that specific segment. They compete directly with other industry heavyweights, names you might recognize like Equitable Holdings, Bright House Financial, Lincoln National, and Prudential Financial, the big public players. Right, as well as major private or foreign-owned players such as Alliance, Athene, and Corebridge Financial. It's a crowded, competitive landscape, no doubt, but JXN definitely holds its own, especially in VAs. So, let's really unpack this table comparing Jackson to some key rivals. We've pulled some key valuation and performance metrics from year-end 2024 and early 2025. This is where we get some critical insights into how the market perceives Jackson versus its peers.
Right, because market perception drives valuation. And the striking element here is the distinct profile Jackson Financial presents compared to its peers. Let's maybe focus on the key takeaways from these numbers without getting bogged down in every single data point.
Good idea. Hit the highlights.
Okay. First, in terms of market capitalization, Jackson is a significant player, sure, at around $6.8 billion, but it's clearly smaller than behemoths like Prudential, which sits way up there around $37 billion, or Equitable Holdings at nearly $16 billion.
So big, but not the biggest on the block.
Exactly. Now, when we look at price-to-adjusted operating earnings forward, which is a really critical measure for valuing insurers, remember, focusing on operations.
Right, stripping out that gap noise.
Jackson trades at a remarkably low 4.65 times forward earnings. Now, to put that in perspective, Equitable Holdings is nearly double that at 8.97 times. Lincoln National is at 5.50 times. Bright House is actually quite similar to Jackson at 4.60 times.
Okay, so Jackson and Bright House seem to be valued similarly low on that metric.
They do. The immediate insight here is that the market is assigning a significantly lower multiple to Jackson's operational earnings compared to many of its larger, perhaps more diversified peers like Equitable or Prudential. Next, consider price to book value at year-end 2024. Jackson trades at approximately 0.65 times its book value. That means its market cap is only 65% of its accounting net worth.
Trading well below book.
Significantly. Contrast that with Equitable and Prudential, which are closer to 1.00 times book value, or sometimes even above. While Brighthouse is even lower at around 0.40 times, and Lincoln National is maybe 0.80 times, Jackson's persistent discount here is a standout point. It effectively means the market is valuing Jackson's underlying assets and accumulated shareholder equity at a pretty steep discount. But here's where it gets really interesting. Their adjusted operating return on equity, ROE, for 2024 was a very competitive 12.9%.
So they're generating good profits on their equity base.
Exactly. This is right in line with, or even arguably better than, many of its peers. Equitable is often quoted in the 15-16% range, but Brighthouse is more like 10-12% and Lincoln 8-10%. So the crucial insight is that Jackson is generating strong underlying profitability despite those lower valuation multiples the market gives it.
Interesting disconnect there.
And finally, their forward dividend yield is a robust 3.32%. This is quite attractive, especially when you consider that lower valuation. While Prudential and Lincoln National offer higher yields, Jackson's yield is still very competitive and signals a strong commitment to shareholder returns.
Decent yield, low valuation, good ROE.
Yeah, the overarching implication of this comparison is pretty clear. Jackson Financial, with its heavy concentration in legacy variable annuities and, let's face it, a shorter public track record as an independent company, is consistently valued at a discount by the market on both earnings and book value. However, it still manages to deliver competitive operational profitability and an attractive dividend yield. This really begs a significant question for investors, doesn't it? Is this discount warranted given the perceived complexity and risks? Or is the market underappreciating its underlying strengths and the strategic shifts they're making, like with Brooke Re?
That seems to be the central tension in the JXN story. Okay, let's dig into a core piece of the Jackson story now. Their financials. And you might be surprised, maybe even confused when you first look at them. Jackson's official net income, reported under JAP, generally accepted accounting principles, it can swing wildly. I mean, really wildly, almost like a financial roller coaster.
That's a good description. Whiplash-inducing sometimes.
Right, just look at these annual figures, $6.2 billion in net income in 2022, then plummeting to $899 million in 2023, and then a similar $902 million in 2024. And it's not just annual. Quarter to quarter can be just as jarring. Like, they reported a $1.6 billion loss in Q4 2023 versus a $334 million income in Q4 2024. That's a nearly $2 billion swing in just one quarter's reported profit. So what on earth is causing this extreme volatility? The immediate insight here, and it's crucial to grasp, is that it's largely due to the mark-to-market accounting of their derivative hedges.
The hedging portfolio, yeah.
When Jackson uses derivatives financial instruments to manage the risks on those VA guarantees, any gains or losses on those derivatives have to be recognized immediately on their income statement under GAAP. However, the changes in the value of long-term insurance liabilities that these derivatives are actually hedging are often not recognized in the same way, or certainly not at the same time, under GAAP rules.
It's an accounting mismatch, a timing difference.
Exactly. It creates this significant timing mismatch, which can drastically distort reported net income, making it incredibly confusing for investors trying to gauge actual underlying business performance. This is precisely why management, and frankly most analysts who follow the company, prefer to focus on adjusted operating earnings.
The non-GAAP number.
Right. This is a non-GAAP measure specifically designed to exclude that market-driven accounting volatility. The whole point is to offer a much clearer, more consistent view of Jackson's core profitability, stripping away all that accounting noise from the derivatives. And when you look at that metric, you see a far more stable, more predictable trend. Adjusted operating earnings were $1.5 billion in 2022, $1.1 billion in 2023, a dip there, and then back up to $1.4 billion in 2024.
Still fluctuates, obviously, business conditions change.
Of course, but it's nowhere near the wild extremes you see in the GAAP net income figures. Much more sensible looking.
The powerful takeaway for investors here is that adjusted operating earnings is the metric that truly reflects the underlying health of the business. It focuses on the core drivers like assets under management, those investment spreads we talked about, and operating expenses. It allows us to see how well Jackson is managing its fundamental operations day to day.
Like the real business performance.
Exactly. This gives a much more reliable picture of the company's ability to generate cash and sustain its business model, even if it requires looking beyond the headline JAP figures. You kind of have to look beyond them with Jackson.
Exactly. Now, let's quickly look at some other key financial trends from 2022 to 2024, using those more stable metrics where possible. Their adjusted operating return on equity, or ROE, is a good indicator of how efficiently they're using shareholder capital, and it improved nicely from 10.6% in 2023 up to 12.9% in 2024. That signals strengthening underlying profitability.
Getting more bang for the equity buck.
We also see solid book value growth. Their adjusted book value per common share increased from $136.34 at year-end 2023 to $150.11 at year-end 2024. And impressively, this growth was achieved despite the company returning significant amounts of capital to shareholders through buybacks and dividends.
Which is key. They're growing book value while shrinking the share count and paying dividends. That speaks volumes about the intrinsic earnings power of the business.
Now, for an insurance company, capital strength is absolutely paramount. You have to know they can pay claims.
The bedrock of an insurer.
Right. The statutory risk-based capital, or RBC ratio, is the most critical measure of an insurer's financial health. It demonstrates its ability to absorb unexpected losses. And Jackson has consistently shown a really robust position here.
What are the numbers?
544% in 2022, soaring to 624% in 2023, and then settling at a still very strong 572% in 2024. All these figures are significantly above their internal target minimum of 425%.
So a very healthy capital buffer, way above the requirement.
Absolutely. Indicates a remarkably strong capital buffer. Their holding company liquidity is also very healthy. They reported over $500 million in liquid securities at the holding company level as of Q2 2024. This is comfortably above their internal $250 million buffer, which is designed to cover about 2 years of fixed expenses.
So plenty of cash at the parent company level, too.
Exactly. The bottom line, they appear well-capitalized and well-funded. Let's quickly summarize the highlights from the key metrics table just to reinforce these trends. Their total retail annuity sales, after a dip in 23, rebounded strongly from $15.7 billion in 2022 to $17.8 billion in 2024. Good sales momentum.
Driven by RLAs, partly?
Largely, yeah. Total assets under management, or AUM, steadily grew from $290.5 billion in 2022 to $324.7 billion in 2024. Solid AUM growth. GAAP net income, as we discussed, remained volatile, but was stable-ish in 23 and 24, around $900 million, after that massive $6.2 billion outlier in 2022.
The roller coaster.
Yep. Adjusted operating earnings, by contrast, showed a much more consistent range from $1.45 billion in 2022 down slightly, then back up to $1.44 billion in 2024. More indicative. Adjusted operating ROE improved nicely to 12.9% in 2024, and their key operating subsidiary, JNLIC, its RBC ratio, consistently remained well above 500%. Very strong. Finally, capital return to shareholders, which is a major focus for Jackson, increased substantially from $482 million in 2022 to $631 million in 2024. They're definitely sending cash back. Now, here's where we get to a truly game-changing development for Jackson's financial story and potentially for how investors view them. The launch of Brooke Re in early 2024.
This is a really big deal strategically.
It feels like it. So what exactly is Brooke Re? Well, it's Brooke Life Reinsurance Company, a newly formed captive reinsurance subsidiary. Basically an insurance company they set up to insure their own risks. The profound why behind this move is a critical strategic pivot. Jackson transferred a significant portion of the market risk associated with its massive legacy, variable annuity guarantee benefits, into this new entity, Brooke Re.
So isolating that VA guarantee risk.
Exactly. The key objectives are very clear. 1, achieve more efficient risk management. 2, generate more stable and predictable statutory capital at the operating company level. 3, significantly reduce that RBC ratio volatility that can rattle insurers and regulators. And 4, provide much greater transparency into the core profitability of their underlying VA business. The anticipated impact here is huge. They're expecting this structure to create a much better alignment between their economic hedging results, what's actually happening with their hedges, and their GAAP accounting figures.
Trying to bridge that gap we talked about.
Precisely. The ultimate goal. To significantly reduce that extreme net income volatility we saw earlier, making their reported financials far less of a confusing roller coaster ride going forward.
That's the critical insight here. This really raises an important question, though. Can this single strategic maneuver genuinely simplify what's been historically complex financial picture? Can it provide the stability needed for long-term growth and maybe evaluation re-rating?
That's a billion-dollar question, isn't it?
Yeah, it is. Brook Re is designed as a sophisticated shock absorber for that VA risk. By consolidating the market-driven volatility into this captive subsidiary, it theoretically allows the underlying operating company, JNLAC, to generate more predictable statutory capital. This, in turn, should facilitate more consistent capital flows up to the holding company.
Which then directly funds their aggressive capital return program and growth investments.
Exactly. It's a foundational, arguably ingenious piece of their long-term de-risking and capital management strategy. They're aiming to tame the beast of VA market sensitivity, or at least make its impact more predictable on the financials investors see.
And finally, just quickly, it's worth clarifying a significant but common divergence you see in insurance financials: the difference between cash from operations and net income. In 2024, Jackson reported $902 million in GAAP net income, right? But they reported an impressive $5.8 billion in cash flow from operations.
Huge difference.
It is. But this isn't necessarily a red flag. It's actually quite typical for insurers. The large difference is due to substantial non-cash accounting items, like changes in reserves for future policy benefits, and, again, that derivative accounting noise.
Cash flow is often seen as a more reliable indicator for insurers than GAAP earnings.
It can be. And a key point for investors is that Jackson is not a capital expenditure-hungry business. They don't need to build lots of factories or buy tons of equipment. So a large portion of that robust cash flow from operations is readily available for other strategic uses, like returning capital or funding growth. Okay, so with all that foundation, understanding their business, their market, their financials, how is Jackson charting its course forward? What's the plan? They're really leaning into organic growth levers to diversify their future. The core theme is strategically moving away from such heavy reliance on that traditional, riskier variable annuity block. This is a deliberate and significant strategic shift.
The tale of two books again. They need to grow the second book faster.
Exactly. Their IIL Cassette is a prime example of this diversification in action. We've already highlighted the exceptional growth, sales up 61% in 2023, and maintaining strong momentum, with a 47% year-over-year rise in the fourth quarter of 2024 alone.
That's really strong growth in a key product.
It shows they're clearly tapping into a sweet spot in the market with these hybrid products, which offer that compelling balance of market participation and downside protection that resonates with people right now. And it's not just RILAs, there's also been an FIA uptick. Sales of their fixed and fixed index annuities are also on the rise. This is supported in part by their asset managers' capability to source higher-yielding assets, which helps them back these spread-based products profitably, even in a changing rate environment.
So growth in both RILs and the more conservative fixed side, too?
Right. This product diversification strategy serves a dual benefit. It allows Jackson to tap into some of the highest growth segments of the annuity market, and crucially, it simultaneously helps reduce JXN's overall risk profile by spreading out their product mix away from just VAs. Another cornerstone of their growth strategy is distribution channel expansion, with a sharp focus on that burgeoning RIA frontier we mentioned.
Reaching those fee-based advisors.
Yeah, they're making a concerted effort to penetrate the rapidly growing registered investment advisor channel. And they're tailoring products specifically for this fee-based advisory market, which often has different needs and preferences than traditional commission-based channels. They're even using specialized entities called outsourced insurance desks, or OIDs, to streamline access for RIAs.
That's smart. Makes it easier for RIAs who aren't typically insurance experts to use their products, overcoming friction.
Exactly. It helps them truly integrate with that advisory ecosystem. And it's not just about new channels or existing products, it's also about continuous product innovation. They seem to be constantly launching new products and enhancing existing ones to maintain their competitive edge.
You have to in this market. It moves fast.
Definitely. For instance, they recently introduced a new fixed index annuity that includes a guaranteed minimum withdrawal benefit, offering more security features. They've also added new index options, like the popular NASDAQ 100, to their RILA suite, demonstrating a responsiveness to market trends and investor preferences. This continuous innovation is absolutely crucial for staying relevant. Now, beyond the big capital return story, which we'll get into next, Jackson is also making important, though perhaps less publicized, investments in digital transformation initiatives.
Modernizing the back end and the advisor experience.
Right. These are vital for long-term efficiency and for strengthening those crucial advisor relationships. A key initiative is the planned July 2025 launch of a new digital experience specifically designed for financial professionals. The goal is to significantly improve the ease of doing business with Jackson, making it simpler and faster for advisors to work with them.
Reducing friction for advisors is key to keeping their business.
Looking at management's strategic priorities, their framework seems remarkably clear and consistent. First and foremost, sustainable growth and diversification. The primary goal is to capture opportunities that will deliberately diversify earnings away from that large legacy VA block.
Grow the new book.
Second, disciplined capital deployment. This means they only deploy capital to its highest and best use, investing only where returns are expected to exceed their cost of equity. No vanity projects. Third, they have an explicit strategy of returning excess capital to shareholders, primarily via dividends and opportunistic share repurchases, especially when those high-return internal investment opportunities aren't readily available or don't meet their hurdles.
A clear hierarchy for capital use.
And finally, a major priority, as we've already highlighted, is leveraging Brook Re, their new captive reinsurance structure, to deliver more predictable financial performance and stable capital generation. That underpins a lot of the rest. So with all these moving pieces, what does this all mean for the long-term viability of Jackson? It certainly sounds like a fascinating self-funding model is at play here.
It absolutely is, and it's a powerful insight into their operational design. The mechanism is quite elegant, really. The predictable and substantial cash flows generated by that now theoretically de-risked legacy variable annuity block, thanks to Brook Re. Right. Those cash flows are strategically channeled for two primary purposes. First, to fuel one of the most aggressive capital return programs in the insurance sector, effectively rewarding existing shareholders handsomely. And second, to fund the necessary investments and statutory capital required for their new high-growth product lines like RLAs and FIAs, where they need to build scale.
So the old business funds the new business and shareholder returns.
In a nutshell, yes. It's a highly efficient capital strategy, at least for the medium term. Jackson consistently generates over $1 billion in what they call free capital annually. This is essentially the cash generated by their in-force business after accounting for the capital needed to support it and maintain their target RBC ratios. A significant portion of this, they've explicitly targeted $800 million for 2025, is earmarked for shareholder returns.
Wow. That's a big chunk of the free capital going back to shareholders.
It is. The remaining portion must then fund the growth of those new business lines, RLAs, FIAs, the RIA channel push, where Jackson is making inroads but isn't yet the dominant leader it historically was in VAs. This creates what I sometimes think of as a race against time. The fundamental question for Jackson, and therefore for investors trying to value the company, is this. Can their new RLA and FIA businesses grow their assets under management and, more importantly, their earnings quickly enough to offset the inevitable slow runoff and decline of that shrinking legacy VA block?
Because the VA block will eventually shrink as policies mature or lapse.
Exactly. It's a melting ice cube, albeit a very large and profitable one for now. If growth in these newer products were to falter significantly, Jackson could potentially transition into what some market watchers might term a runoff story. In that scenario, its value would primarily be derived from the discounted cash flow of its existing declining book of business rather than future growth.
A less exciting prospect for investors.
Much less. Conversely, some skeptics might view the aggressive capital return policy, while obviously beneficial for current shareholders in the short term, as a potential signal that the company sees limited internal high-return growth opportunities to reinvest that capital in.
They're buying back stock because they have nothing better to do with the cash argument.
Precisely. The ultimate long-term value of Jackson Financial really hinges on its ability to prove the skepticism wrong by successfully executing its growth and diversification strategy with these newer products. They need to show they can replace the old engine with a new one.
Okay, building directly on that self-funding model and the concept of free capital, let's really zero in on Jackson's truly aggressive and consistent capital return policy. This isn't just a side note. It's been a central pillar, a defining characteristic of their strategy ever since their September 2021 spinoff.
It's definitely front and center in their investor communications.
It is. And the striking insight here is the sheer scale. JXN has returned over $1.8 billion to its common shareholders just since becoming independent. That really underscores the cash-generative nature of this business model. They've been particularly assertive with share repurchases. Since the demerger, they've repurchased an astonishing 23.4 million shares. Now, to put that in perspective, that's nearly 25% of their initial shares outstanding when they spun off.
A quarter of the company bought back in just a few years. That's significant.
It's huge. The scale of these buybacks has been substantial and growing, increasing from $255 million worth in 2023 to a significant $415 million in 2024. These consistent buybacks, even net of any minor issuances for compensation, have effectively reduced the number of outstanding shares from around 78.7 million down to 73.4 million just in 2024.
Which boosts earnings per share and gives remaining shareholders a bigger piece of the pie.
Exactly. For shareholders, fewer shares means their piece of the company gets larger, all else being equal. And they've also been committed to growing dividends. Jackson has established a reliable track record now of consistently increasing its quarterly dividend payout.
Building that dividend growth story.
They are. They boosted up by 13% to $D.62 per share in early 2023, then followed that with another 14% increase to $2.70 per share in early 2024, and it was raised again to $D.80 per share starting the first quarter of 2025.
Pretty hefty increases year after year.
They are. These consistent increases serve as a strong signal for management, demonstrating their confidence in the stability and predictability of their future cash flows, likely bolstered by the Brook rechanges.
The striking element here, I think, is how transparently management has communicated their capital return targets and, perhaps more impressively, how consistently they've actually met or even exceeded them.
They set targets and hit them.
Yeah, that cultivates a high degree of predictability for investors, which is a rare and valuable commodity in the financial sector, especially for an insurance company often perceived as complex. Let's just quickly look at their targets versus achievements because it paints a clear picture. In 2022, their target range was $425–525 million. They delivered $482 million, right in the middle. In 2023, the target was $450–550 million, and they returned $464 million, again within range. In 2024, they aimed for $650 million and actually achieved $631 million, slightly over-delivering.
Beating their own goal.
Right. And for 2025, reflecting that increased confidence, likely tied to Brook Re maturing and continued business performance, the target has been significantly raised to a range of $700–800 million.
That's a big jump in the target.
It is. This track record of consistent delivery builds immense credibility with the market and signals a fundamental strength in their capital generation capabilities.
It absolutely does. And it naturally leads us to ask about the sustainability of these capital returns. Can they keep this up? The crucial insight here is that this aggressive program appears not to be debt-funded.
That's important. They're not just borrowing to buy back stock.
Exactly. It seems fundamentally backed by strong, predictable capital generation directly from the underlying insurance business, which is a key differentiator and makes it feel more sustainable. We discussed free capital generation earlier. Remember, at the operating company level, JNLIC, JXN defines this as its statutory earnings adjusted for the capital required to support its business lines and maintain those high RBC ratios. They generated over $1 billion of this free capital in 2024, and they expect to exceed that figure again in 2025 under normal market conditions.
So that's the source pool. Over $1 billion a year.
That's the source pool. And all their capital actions, dividends, buybacks, and investments in new growth are funded from that pool. Now, a portion of that free capital flows upstream from the insurance subsidiary to the parent holding company as holding company free cash flow. This is the direct source that actually funds the shareholder returns, dividends and buybacks, and covers corporate expenses.
The cash that actually reaches the top level.
Right. In 2024, this amounted to a robust $767 million. And for the 12 months ending June 30, 2025, it's projected to reach $1.0 billion. So the cash is clearly there at the holding company level, and it's flowing reliably. Finally, just touching on their capital structure and debt management, it seems to reflect a prudent approach. At the end of 2022, they reported a modest financial leverage ratio of 18.3%.
Pretty low leverage for a financial company.
It is. It indicates a conservative use of debt in their overall capitalization. This disciplined approach helps ensure that their ambitious capital return program remains sustainable and isn't simply relying on financial engineering or stretching their balance sheet too thin. Okay, every investment involves risk, and every financial institution operates with inherent risks. Jackson Financial is certainly no exception. Let's explore the landscape of potential challenges they navigate. We have to talk about the risks.
Absolutely crucial, especially given the nature of their business.
Let's start with what are arguably the most significant ones for Jackson: market and interest rate risks. When we talk about equity market sensitivity, That very large block of legacy variable annuities makes their fee income directly sensitive to market downturns. We touched on this before.
AUM drops, fees drop.
Exactly. If the stock market dips significantly, their AUM shrinks, and so does that critical fee income stream. But maybe more importantly, a sharp decline in the market increases the net amount at risk on those guaranteed benefits offered on VA contracts. The difference between the guarantee and the account value widens.
Which puts pressure on their reserves and hedging.
Right. This could potentially trigger significant hedging losses if the hedges don't perform perfectly and put a strain on their statutory capital. It's their biggest market exposure. Interest rate sensitivity is equally complex and multifaceted for Jackson. Declining interest rates, for example, can increase the present value of their long-duration liabilities, making future promises more expensive today. It can also negatively impact returns on their vast investment portfolio as they reinvest maturing bonds at lower rates. And it can reduce demand for their spread-based fixed annuity products.
So falling rates aren't necessarily good either.
Not entirely. Conversely, rapid rises in rates can also create challenges. It can increase the cost of certain types of hedging and potentially create disintermediation risk, where policyholders cash out annuities to reinvest elsewhere at higher rates.
A complex relationship with rates.
Very. This dual exposure is precisely why the strategic establishment of RRI, which we discussed, is so fundamentally important. It's explicitly designed to provide a more robust and efficient hedge against the combined impact of both equity market shocks and interest rate shocks, aiming to stabilize capital and earnings across different scenarios. Okay, beyond market forces, there's credit and counterparty risk. Jackson's substantial investment portfolio, remember, they invest the premiums, has exposure to credit risk from its holdings of corporate bonds, commercial mortgage-backed securities, CMBS, and direct commercial mortgage loans.
Standard insurance portfolio assets, but they carry risk.
Right. A significant credit event, like widespread defaults during a recession, or even a large single default in their portfolio, could lead to investment losses. And then there's reinsurance counterparty risk. Jackson, like many insurers, uses reinsurance agreements to offload or manage certain blocks of risk. But this introduces the risk that the reinsurer itself might fail to meet its obligations when a claim arises.
The reinsurer could go bust.
Exactly. And we saw a tangible example of this in the second quarter of 2023. JXN actually recorded some credit losses because a specific reinsurer they used had been ordered into liquidation. So it's not just a theoretical risk, it has real-world financial implications for them. Moving on, we have regulatory and compliance risk. We touched on this before, too. The annuity industry operates under this dense and complex web of regulations, primarily at the state level, but with increasing federal oversight.
Constantly changing rules?
Seems like it. Changes in capital requirements, like the RBC rules, new regulations governing product features, evolving sales practices like those best interest standards for advisors, or even shifts in tax laws could all materially impact Jackson's business model, its profitability, and its capital needs. It's an ever-evolving, always watchful landscape they have to navigate. And finally, there are significant operational and business risks. This includes things like policyholder behavior assumptions. Annuity pricing and the reserves they set aside rely heavily on complex actuarial assumptions about things like how long people will live, mortality, how likely they are to surrender their policies early, lapse rates, and how people actually utilize those guaranteed benefits.
Assumptions about the future.
Yes. If actual experience deviates unfavorably from these assumptions, say, people live much longer than expected or utilize guarantees, more often it can lead to significant financial losses down the road. And these assumptions are subject to annual review, which can sometimes lead to significant adjustments to reserves. There's also ongoing competitive pressures. The annuity market is intensely competitive, as we noted. This leads to constant pressure on fees, on the commissions paid to advisors, and potentially compressing profit margins over time. And like any modern company, they face significant technology and cybersecurity risks. They rely on complex IT systems for everything. A major system failure or a successful cyber attack could cause widespread disruption, financial loss, and severe reputational damage. That's a risk for almost everyone now.
So the critical point emerges, maybe pulling that a bit. What's the ultimate catastrophic risk here for investors? You hear insurance company, you think risk.
Right, the black swan event.
Exactly. As a highly regulated insurance company, Jackson is subject to stringent capital requirements, specifically designed to ensure it can meet its obligations even in severely stressed market conditions, like another financial crisis. Their consistently high RBC ratio, which we highlighted earlier, is a key measure of this resilience they hold capital specifically for those stress events. A truly catastrophic loss for Jackson, the kind that would wipe out shareholders, would likely require a systemic financial crisis far worse than anything seen in modern history, coupled with a simultaneous failure of the state-level insurance guarantee funds, which backstop policyholders.
So multiple layers of protection would have to fail.
Multiple layers. While no investment is entirely without risk, the probability of a total loss on an investment in Jackson, given these layers of regulatory capital and guarantee fund protection, is exceptionally low. It's not zero, but it's very, very low.
That's really reassuring context for the risks involved. Now let's dive into valuation analysis, because this is where things get really interesting with Jackson. JXN's stock has consistently traded at multiples that appear quite low compared to many of its peers, and certainly compared to the broader market. This persistent discount is a core part of the investment debate surrounding JXN. For current valuation metrics, the GAAP PE ratio for JXN, as we've beaten to death, is often meaningless due to that extreme volatility. Forget JPE.
Agreed. Don't even look at it.
Instead, we look at the forward price to adjusted operating earnings ratio. Based on analyst estimates for 2025, that's typically been in the range of 4x to 5x.
4 to 5 times operating earnings.
The immediate insight that is remarkably low compared to the broader market, which often trades in the high teens or even low 20s. It's also low compared to many financial peers, as we saw earlier. And their price-to-book, PB value, is another striking indicator of this discount. Jackson consistently trades at a significant discount to its accounting book value. Adjusted book value per share was $136.34 at year-end 2023 and grew nicely to $150.11 at year-end 2024.
So the underlying value is growing.
It is. But the stock price is frequently traded at a fraction of these underlying values, sometimes well below 0.5x book value, indicating a deep discount in market perception relative to the stated net worth of the company. Looking at historical valuation ranges, since its spinoff in late 2021, JXN stock has certainly been volatile, but it has persistently traded within a low valuation band relative to both its book value and its operating earnings.
It hasn't really broken out to a higher multiple range yet.
Not sustainably. This suggests the market has consistently applied a discount, likely due to the perceived risks and complexity of its legacy business model, maybe the hedging opacity, and certainly its shorter track record as an independent public company. When we compare this to its peer valuation benchmark, we already saw Jackson's lower PBE and adjusted operating earnings multiples compared to companies like Equitable Holdings and Prudential are quite stark.
Though closer to Braid House, interestingly.
True. This valuation gap can largely be attributed, most analysts think, to Jackson's higher concentration in that legacy variable annuity business, the historical opacity or complexity of its financial statements, which Brooke Re aims to fix, and just having a shorter track record for public market investors to analyze.
Okay, this brings us squarely to the core debate. Is this persistent discount justified, or is it actually a hidden opportunity for investors?
It's a $1 million or maybe billion-dollar question.
Let's first consider the bearish view. Why might the stock deserve to be cheap? Proponents of this perspective argue that the discount is entirely appropriate, maybe even not large enough. What's their argument?
They would point directly to the inherent risks of that large market-sensitive VA block, which we've discussed extensively. They'd argue it's just intrinsically risky. They would also emphasize the sheer complexity of the company's hedging program and financial reporting, arguing it remains somewhat opaque despite management's efforts. And finally, they would highlight the long-term uncertainty about whether that new business growth can really offset the inevitable runoff and decline of the legacy VA block.
So for bears, it's just too complex, too risky, maybe too hard to predict to warrant a higher valuation. Stick with simpler stories.
That's the essence of it. But then there's the bullish view, which naturally contends that the discount is excessive and fails to adequately credit the company's significant strengths and recent improvements.
Okay, what's the bull case?
Bulls would highlight the strong, stable, and predictable statutory capital generation that flows from the business, especially post-Brooke Re. They would emphasize the material de-risking of the business model achieved through the creation of Brooke Re, arguing it genuinely simplifies the financial picture and reduces tail risk. They would definitely point to the high and sustainable capital return program, the dividends and buybacks, as a tangible benefit and sign of confidence. And they'd highlight the very real tangible growth being achieved in the RLA and FIA businesses as evidence the transition is working.
So for the bulls, Jackson is an undervalued gem. Its fundamental strengths, cash flow, capital returns, de-risking are being overlooked by a market that's perhaps overly focused on historical complexity or VA risk.
That sums it up well. An undervalued cash cow that's actively de-risking and growing new shoots. Let's just quickly glance at that historical valuation table again to see how this debate has played out in market prices over time. Back in Q4 2022, Jackson's stock price was around $41.67 against an adjusted book value per share of $115.36. That resulted in a very low PAJACT, book value multiple of just 0.36x, dirt cheap on a book basis.
Trading for about a third of its book value.
By Q4 2023, the stock price had risen to $52.05, and add-back book value per share had grown to $136.34. But the multiple, the PAJACT book value, had only slightly increased to 0.38x, still deeply discounted.
So the stock price went up, but so did the book value, keeping the multiple low.
Exactly. However, in Q2 2024, we saw a more significant jump in the stock price to $82.23. With an AJAC book value per share now at $155.11, the PAJAC book value multiple rose more meaningfully to 0.53x. That showed growing market recognition, perhaps.
Starting to close the gap a bit.
And for the current Q3 2024 period, the stock price is hovering around $97 against that latest AJAC book value per share of $155.11. This puts the PDA book value at approximately 0.63x. So, the key takeaway from this historical data is that while the price-to-adjusted book value multiple has been gradually increasing, suggesting a slow but steady market re-rating and maybe narrowing of that stubborn discount, Jackson's stock is still trading significantly below its adjusted book value.
Still less than two-thirds of book value. The discount persists.
It does. The debate clearly continues, but the market is definitely starting to pay more attention to the underlying improvements and the cash flow story. Whether it fully re-rates, well, that remains to be seen. Okay, beyond the complex numbers and strategic maneuvers, the individuals steering the ship are absolutely crucial to any company's success, aren't they?
Leadership matters immensely. Tone at the top, execution capability.
Right. Let's briefly examine Jackson's management team's experience and track record. What's striking here is the incredibly deep institutional knowledge. The company is led by President and CEO Laura Prieskorn. She boasts an impressive career, having been with Jackson for over 30 years in various senior roles.
30 years. That represents a wealth of direct, hands-on business expertise within this specific organization. Knows it inside out, presumably.
You certainly think so. And this pattern of promoting from within continued with the relatively recent June 2024 appointment of Don Cummings as the new CFO. He previously served as the company's controller and chief accounting officer.
So another internal promotion to a key role.
Yeah. Now, while this ensures remarkable continuity and an intimate understanding of the business from the very top, you could argue maybe some might consider whether it also signals a potential lack of fresh, external perspectives being brought in at the highest executive levels.
That's always the trade-off with internal promotions, isn't it? Deep knowledge versus new eyes.
It is. However, looking at their performance since the company's spinoff, this management team has demonstrated incredibly strong execution. There's no denying that. They've successfully navigated some highly volatile market conditions. They've consistently maintained a robust capital position well above regulatory minimums. They successfully executed the complex formation and implementation of the Brooke Re captive reinsurer.
Which was a major undertaking.
Huge. And notably, they have met or even exceeded their publicly stated capital return targets in every full year since becoming an independent company. That is an undeniable track record of delivering on promises. Now, in terms of corporate governance practices, how the company is overseen, Jackson appears to have implemented several key features designed to ensure strong board independence and alignment with shareholder interests.
The checks and balances.
Right. For example, they've clearly separated the critical roles of CEO and chair of the board. That's generally seen as good practice. Stephen A. Kandarian serves as the independent chair. He brings nearly 2 decades of senior executive leadership experience from other major firms in the insurance and annuity industries, including CEO experience.
So an experienced industry hand-providing independent oversight, that's valuable.
Seems so. The board also seems highly engaged with shareholders. They reported having over 40 meetings with shareholders representing approximately 30% of the company's outstanding shares in 2023 alone. That shows a clear commitment to dialogue and accountability, listening to their owners.
This naturally leads us to ask that crucial question again. Are management's motivations genuinely aligned with yours as a shareholder? How are they paid? The executive compensation structure at Jackson suggests a pretty clear pay-for-performance philosophy. Well, it's heavily weighted towards at-risk, performance-based compensation. To illustrate, in 2023, an impressive 89% of the CEO's target total compensation was considered at risk. That means the vast majority of her potential pay was contingent on achieving specific company goals, not guaranteed salary.
So performance really drives their paychecks.
Seems that way. Their short-term incentives, like the annual cash bonuses, are tied to precise metrics. Pre-tax adjusted operating earnings carries a hefty 60% weighting, controllable costs are at 20%, and achieving key strategic objectives makes up the final 20%, so clear targets. For long-term incentives, the awards are a thoughtful mix of performance share units, PSUs, and restricted share units, RSUs. The PSUs are particularly important as their vesting is contingent on achieving specific 3-year performance targets for metrics like net cash flow available to the holding company, JFI, and adjusted operating ROE.
So they need long-term results to get those shares.
Exactly. And in a further move to enhance shareholder alignment, they added a relative total shareholder return, or RTSR, modifier to their PSU awards starting in 2023. This means the final payout can be adjusted up or down based on how Jackson's stock performs relative to a defined peer group.
So they get rewarded more if the stock outperforms peers, less if it underperforms. Direct link.
Precisely. Directly linking executive reward to the actual investor experience relative to competitors. Plus, executives are required to hold a significant amount of company stock. The CEO's requirement, for instance, is set at 7 times their base salary. That ensures they have significant skin in the game alongside shareholders. And importantly, just looking at the overall quantum, the total grant date fair value of stock and performance-based awards for the top 5 named executive officers in 2023 was approximately $13.6 million. Now that sounds like a lot, but it represents only about 1.5% of the company's 2023 adjusted operating earnings. That's well below typical thresholds that might raise concerns about excessive insider compensation diluting shareholders.
Okay, so the structure seems robust, performance-linked, and not excessively large relative to earnings, appears well aligned.
Yeah. Based on the disclosures, the structure appears robust and clearly aimed at aligning management incentives with creating long-term shareholder value. Hashtag outro.
And that brings our deep dive into Jackson Financial Inc. to a close. We've certainly covered a lot of ground today, haven't we?
We definitely have. It's a complex company.
It is. We charted JXN's journey from its pivotal spin-off from Prudential. We explored its complex yet fascinating tale of 2 books, business model of the legacy VAs versus the new growth engines. And we really dissected that strategic pivot with the creation of Brooke Re. We've seen their aggressive and consistent commitment to shareholder returns through dividends and buybacks. And we acknowledge the ongoing intricate challenge they face, balancing a profitable yet market-sensitive legacy business with the exciting high-growth opportunities of its new product lines like RLAs and FIAs. Our hope today is that you now walk away with a much clearer, more nuanced understanding of this complex company. Maybe you feel like you've avoided the typical information overload you might get trying to research this on your own.
Cut through the noise a bit.
Hopefully. And crucially, maybe gain some valuable aha moments about the annuity market itself, how insurance financials work, especially that gap versus adjusted earnings piece, and how Jackson fits into that dynamic sector. You've now seen how Jackson is not just trying to clarify the complexity of retirement planning for its customers, but is also actively working through things like Brooke Re to bring greater clarity and stability to its own financial story for investors. So as you reflect on Jackson's intricate balancing act, growing that new business while prudently managing its legacy block and generously returning capital, what single factor do you think will ultimately determine its long-term success?
That's a great closing question. What's the key determinant?
Is it just the relentless focus on driving those new product sales, the RILAs and FIAs? Is it the stability and predictability potentially offered by the Brooke Re structure finally calming market nerves? Or will it be the market's eventual, perhaps overdue, recognition of its persistent valuation discount? What ultimately unlocks the value here? Something to think about. Consider these points as you continue to navigate your own financial understanding and perhaps your own retirement planning. Thank you so much for joining us on this deep dive. We'll be back soon with another one.